Things are moving again in crypto, but in what direction? We saw Bitcoin surge from 28,000 to nearly 31,000 in just a few days last week, but it's down nearly 5% this week. On the policy front, we saw the surprise release of a US draft bill to regulate stablecoins, followed by a congressional hearing on Wednesday. But SEC Chair Gary Gensler held the hard line on crypto in his testimony the day before. Is the crypto winter beginning to thaw, or is Operation Choke Point 2.0 just getting started? Joining us now is Nevin Freeman, co-founder of stablecoin platform Reserve, and he's going to help us get a read on these regulatory and market developments in crypto. Nevin, welcome to Kitco News.
Thanks for having me.
Very happy to have you. We've got a lot going on here, and you are exactly in the right area for this. So very happy we could have you today. So let's start with stablecoins. Why are stablecoins so important? What role do stablecoins play in the overall health of the crypto ecosystem?
Well, on a high level, I think money is the obvious initial usage of blockchain technology. There's many other possible usages, but money is a pretty obvious one. And as anyone who's tried to use Bitcoin or other volatile crypto assets as money knows, it's not a very convenient way to store your savings or spend. And so stablecoins represent, I think, the right way forward for us to explore how to use crypto technology as money around the world. People obviously, for the most part, use stablecoins as part of speculative trading activities these days, but we do start to see stablecoins being used more and more for ordinary transactions and savings in economies where essentially access to US dollars is attractive and not necessarily easy to get. So I see stablecoins as really the natural evolution of crypto technology into ordinary commerce and finance.
All right. And are stablecoins more important in regions that don't have access to reliable banking services or that have seen their financial systems distressed?
I think so. When I talk to my friends here in the United States about cryptocurrency and stablecoins, nobody really is interested in using them as their ordinary form of payment. There's lots of services that pretty much handle the needs that consumers have today. But in economies that have undergone hyperinflation or economies that have capital controls or other challenges, I think stablecoins represent an interesting way to get access mainly to US dollars. It's not really the case that we come across a whole lot of people who are especially excited to use crypto as money, but we do come across a lot of people who are especially excited to use the US dollar as their currency of choice. And stablecoins often present a novel way to do that, sometimes in environments where you wouldn't have been able to do it before. And so it's really sort of the desire for dollars that is driving the usage of stablecoins in economies that have currency issues in our experience.
Right. And then I guess in more developed economies or more stable economies with more stable banking systems, the stablecoin is just the way to get the currency into the crypto system. And the real appeal is crypto. The more you could say speculative or more volatile, and volatile is not necessarily a bad word in crypto, obviously, because volatile is up as well as down. So stablecoins are really the US dollar of crypto trading, but in economies where fiat itself is coming apart, stablecoins represent a way to have a stable currency in the first place.
Yeah, that's right. And I don't want to, I do think that that's the state of affairs today. I don't want to belittle the possibility that developed economies could massively switch to the use of stablecoins for ordinary savings and commerce, because I do think that there is quite a lot of opportunity there as well. If you've made an ordinary bank wire anytime in the past couple of years, that can sometimes be a big headache, whereas sending a USDC transaction pretty much just always works. And so that plus the immense efficiencies and power of smart contracts to transact, all sorts of different monetary instruments, which today are mostly those speculative crypto assets, but could in the future represent all sorts of real world value. I do think that the opportunity for even just US dollar stablecoins in developed economies like the US is really very big. It's just going to take quite a while to get there to start to build a network of users who are using them for ordinary things, and to allow more and more of the safe and traditional financial assets into the smart contract world, in order to sort of do what we already do in perhaps a much more efficient and often safer way.
Right. So this is the idea of tokenization of existing assets, existing securities often, where you're getting the benefits of 24/7 seamless trading, very low fees, fractionization, being able to break these up into tiny amounts, and have the benefits of, so this is really the benefits of tokenization for existing securities, not necessarily getting excited about the value of crypto itself.
Exactly. Like if you just think about, for any of your viewers who have used Uniswap, Uniswap is what's called an automated market maker. It allows anyone who wants to list any trading pair between any two crypto assets on the Ethereum blockchain, but these exist on every smart contract platform now. And then anyone can come and pool their liquidity. They can basically say, I have some of these assets and some of these assets, and I'll set them both here in the smart contract for anyone to come who wants to trade back and forth in either direction. So anyone can become a market maker. It's extremely easy. And then that means that anyone else can come and trade with that smart contract 24/7, very low fees. It's extremely efficient. And what's so mind-blowing about Uniswap, if you compare that to the NASDAQ or the New York Stock Exchange and the brokerages and all the infrastructure that goes into allowing us to trade securities back and forth today, Uniswap is extraordinarily efficient. It's just a piece of code that's there running that entire operation, and there's no opportunity for fraud because there's no central party, right? So crypto has recently gotten a bad rap because of what happened with FTX misappropriating user funds, and that was obviously completely terrible. But a decentralized automated market maker like Uniswap, there's no possibility for that sort of thing to happen, and so I'm very, very excited about the ways we could use this technology to actually offer more consumer protection to users than regulations ever could. Even in the regulated securities industry, there's still that opportunity for malfeasance, and that's why we need the regulations. It's so beautiful and elegant that in some cases, at least, you can use smart contracts to eliminate those risks entirely for users. And so, yeah, I think that in the future, if we choose as a society to tokenize all of the existing securities, equities and bonds and so forth, the amount of efficiency we could get from that in the financial system and the amount of consumer protection is extremely exciting.
Right, and also just the idea of growing that market, because once something is tokenized and it can be traded around the world, or at least the token that represents it is traded around the world, you then, and fractionally, so something that is worth, say, $2,000 can be split up into 2,000 pieces, and then you can buy $50 worth of it. So the market, the potential growth of that market is also enormous, because you're then tapping into a global market for essentially securities.
Yeah, that's right. And I do think that we have to go into that future with open eyes and think about the risks and challenges. That's something that our team has spent some time thinking about. We're kind of preppers in that sense. And one thing that I do worry about, and I think regulators will worry about, is well, would it be the case that disaligned states could acquire large shares in key, companies in the United States that are important to our national security and control those companies if we tokenized everything and got rid of those limitations? That's an example. Maybe there are other things, other challenges that need to be considered as well before we just barrel into that future. I think with that particular challenge, a natural solution could be allowing anyone to acquire an economic interest, but to require that token holder to prove their U.S. citizenship before they can participate in actually voting those shares in a U.S. corporation, for instance. And that's also something that could be orchestrated on the blockchain. You could allow people to prove that citizenship or not prior to being able to exercise, say, votes in a smart contract. And so there's really a lot of thinking about the implications before we just rush to tokenize everything that I think we need to do. But the good news from my perspective, we've been out ahead thinking about this in the reserve offices, and we think that so far everything we've noticed, there is an elegant solution that can be implemented. So it's going to be a long road, I think, working that out, not just on the level of entrepreneurs thinking about it themselves, but regulators and policymakers around the world deciding how we're going to handle that. But I think that this is a very innovative industry full of bright minds, and I think that we can actually probably find solutions to those biggest challenges.
Right. Well, you bring up regulators and the need for regulation. So let's get into that a little bit. We did see the draft stablecoin bill published over the weekend, which caught everyone by surprise. I guess you and your team have had a chance to look that over. Well, what did you make of that bill?
Well, I think it's important to note that in the hearing on, I believe it was on Wednesday, many of the members of the committee made it very clear that that bill doesn't really represent something that they're excited to move forward with in its current form. Everyone is unhappy with it to a pretty large degree for one reason or another. And so it was sort of stated in the opening remarks of that hearing that, like, well, we wanted to put something out there to kind of have something to work on, and it, sort of the results of the work that happened last Congress prior to the collapse of FTX and so on. So I think everyone is kind of being like, whoa, whoa, whoa. We're not saying that we're going to actually make this particular draft into a law. And so I think that, when I was reading it, I definitely had that in mind, understanding like, okay, here are the best ideas we've been able to get down on paper so far, but we should expect this to change quite a lot before, actually being thought through and voted on. I think that, so with that being said, I don't envy the job of policymakers. It's so difficult to think through all of the different possible considerations and challenges and try to find something that an entire Congress can agree on enough in order to make a rule or in order to make a policy like this. I think that the general thrust of trying to decide, okay, who's going to be in charge of allowing someone to become a stablecoin issuer or not in the United States, and how are we going to make sure that the assets that are held to back that stablecoin are legitimate? I think that makes a ton of sense, and so I'm very pleased overall to see that we're going in the direction of legitimization of dollar pegged stablecoins rather than a brash move like outlawing them or requiring that they only be issued by the state. And so I think it's a pretty clear signal to the market that privately issued U.S. dollar stablecoins are here to stay in the United States. Some people worried due to recent comments from the SEC side of, maybe stablecoins are securities. Does this mean that we're going to shut them all down and only go forward with a CBDC? I think the answer is no. It looks like there is broad support from Congress for private issuers to issue dollar-backed stablecoins. And then, as to the specific details of the bill, again, I kind of think that it's going to evolve enough that we don't necessarily need to look too hard at the details. One interesting piece, is sort of tossed in at the end, basically issuing a moratorium on essentially algorithmic stablecoins, stablecoins that only have endogenous crypto assets, meaning crypto assets that are sort of issued by the stablecoin creator as their backing, where the draft bill basically says, let's not allow those for the next 2 years, and let's basically put together a report trying to figure out what we're going to do about them. Honestly, I think that's kind of a reasonable thing. It's a little weird to have that in a bill, but I think that we've obviously seen the pitfalls of algorithmic stablecoins. And so, I think for the most part, the crypto industry has learned its lesson, and who knows how long that memory will last. But in the short term, I don't think we're going to be messing around with purely algorithmic stablecoins on a large scale anyway. So having an official moratorium probably wouldn't particularly hamper the innovation that we're likely to see in the stablecoin space.
Right, because the sense, based on how the bill's structured, it looks like what they're trying to do is begin in you could say, the safest, most obvious place, which is stablecoins. So to avoid altogether the debate about whether this or that cryptocurrency is a security or not, is it a commodity, is it a security, who is who's in charge of making that decision, they get to kind of shelve that in the short term because stablecoins are a little bit simpler. And then the only other thing they have to shelve at that point when we're having a stablecoin conversation is they insist on one-to-one backing. It's US dollars or short-term treasuries, one-to-one backing for the stablecoin. And that also simplifies. So that kind of precludes any possibility of an algorithmic stablecoin. And like you said, people aren't necessarily clamoring for those right now anyway. So by narrowing the scope, they can essentially move or at least begin a conversation on that front.
Yep, that's right. And I think one category that the bill doesn't, at least in my reading of it, doesn't quite clearly address is stablecoins that are backed not directly by dollars, but by other crypto assets. In particular, the type of over-collateralized crypto-backed stablecoin, with the most popular example originally having been Maker's DAI. A little confusing because now there's USDC backing as well. And so I think that, again, I don't envy the challenge of lawmakers here because it's going to be a confusing task trying to decide should those just be ignored for the sake of this regulation, or should they somehow be folded in? The thing is, when I think about it for myself, if I was in charge, it's not really clear how to fold them in because there isn't necessarily an issuer in the same way. Someone can create a smart contract that works in whatever way they decide, and that smart contract may be ungoverned or may be governed by a DAO all around the world. And so there isn't really an issuer, or at least a US-based issuer, that could be asked to comply with certain regulations. And so I think the most likely direction there is possibly to regulate who can facilitate the trading of those stablecoins, who can offer them to consumers. But it's not really something that we can, I think, decide, to not allow them to be created or to require a license to create them. And so that's something that is sort of obviously not addressed in the bill so far. And I think it'll be interesting to see if there ends up being any discussion about that, or if that category is generally ignored and not really addressed in any further iterations.
And what do you make of the tone and the structure of the bill? I found it interesting that it seems to be creating responsibilities and obligations on the part of the government as well, not just on the part of the potential issuers of stablecoins. The bill says that the government is obligated to give a response within 45 days telling a potential issuer whether their application is complete or not. And within 90 days, the government is obligated to give them a yes or no on whether they can issue a stablecoin. And if they don't reply in 90 days, it's considered to be automatically approved. This is an interesting, it seems to be obligating the government to not only enforce or tamp down on what they don't approve of in the crypto space. It seems to be essentially obligating the government to take a proactive role and to help to foster the growth and the evolution of this of the crypto ecosystem, at least on the stablecoin side. What do you make of that?
Yeah, I would agree with that interpretation. I think that the deadline for response that's proposed in the bill is sensible, and really makes it so that there is a process that can be followed. And that as you mentioned with the SEC is kind of the challenge right now, right? It's like if you have a private company that you would like to take public, there's a well-trodden path. There's, particular information, is exactly what you need to get together and disclose. And it's a very expensive and cumbersome process to do that, but you know what you need to do. And I'm trying to remember the example. There was a new type of security instrument that emerged several decades ago. And it was in the same position as crypto for a while, where it was unclear how to go to the SEC and register that new type of security for public trading. And we looked at this just from a historical perspective, trying to figure out what is this, does this tell us anything about what will happen with crypto? I believe in that case, it took about 10 years for the SEC to end up basically creating guidance or specific information, a set of information that you needed to submit in order to register that new type of security. So if we apply, if the past repeats itself in that sense, then perhaps it's, a 10-year window between, crypto securities from the perspective of the SEC becoming popular to the point where they're able to sort out basically like the form you fill out in order to disclose the relevant information if you want to offer a crypto security for public trading. I've never, been inside the SEC in any meaningful sense. I don't really know what the agency is like on the inside. Only someone who worked there could perhaps comment on that. There must be some good reason why it's very hard to make a decision like that, right? Because if it were easy, this guidance would have existed in 2017 or 2018. So, I don't, as an industry participant, I do complain a little bit about it, but I don't envy the regulators. I think that there must be something that we don't quite understand from the outside that makes it very difficult to come to consensus or to figure that out. I'm sure many proposals have been made internally. Hester Pierce obviously has been very vocal about wanting this sort of clarity. And so if someone that high up in the organization really wants it and it's still very hard to do, there must be some challenging gridlock that makes it difficult. But yeah, I think that it's really essential that we get to the point where there is a path that's just as obvious as registering a company for public trading, but for crypto assets. And likewise, that digital asset exchanges are able to get licensed, probably with the SEC, for the trading of crypto securities. And we can go back and forth about whether any particular governance token in DeFi is a security or not. But obviously, if we get to the world where we're talking about tokenized equities, there's no reason why an equity that's a token is not going to be a security as well. And so from my perspective, it's obviously going to be very useful and necessary and appropriate for large digital asset exchanges to be, registered in some form with the SEC and to follow similar regulations that national securities exchanges do today.
Right. Yeah. I think what you were thinking of is the evolution of ETFs. ETFs came along, and it took maybe 10 years for them to figure out exactly what to do. And frankly, we saw the same evolution with stocks themselves. Stocks were kind of a crazy, risky scheme for a while, and very volatile and very speculative, and then that ultimately worked out as well. So I guess the 10-year time frame might be realistic, might make sense there. I was wondering, stepping back a little bit from the content of the bill itself, what type of stablecoin bill would you like to see? Maybe don't lay the whole thing out, but what to you, you're in this space and you need a certain amount of clarity. So what would you need to see in a stablecoin bill for it to be workable for you to be able to move forward?
That's a good question. The way that the reserve platform works tends to be not addressed by current stablecoin bill drafts. And I don't have a comprehensive proposal for you of exactly what I would like to see, but I will call out one feature that was present in some of the drafts of the Stablecoin Trust Act bill, which was proposed by former Senator Pat Toomey and was the predecessor to the working draft that we're looking at now. There was language in that draft that essentially helped add clarity to the regime where a stablecoin issuer is allowed to issue a stablecoin and perform AML and KYC functions on the issuance and redemption transactions, but allow anybody to freely transact that token on the blockchain without needing to monitor their transaction or the identity of those who are transacting back and forth, because those are peer-to-peer transactions that are not actually operated by the issuer. And this is obviously how we operate today, but I do think that there is kind of a broad question about is that really okay? Are we going to allow that forever? And I think that that regime of transacting is a huge part of what enables the value of DeFi and stablecoin transactions is the low level of friction that's permitted by allowing, you and I to transact peer-to-peer with a stablecoin on a blockchain that way. And so I think it would be incredibly valuable to essentially put that into legislation and make it clear that issuers can continue to build out their entire business models on that assumption in the way that Circle and Paxos and others have done to date. So that's a part that I would love to see added to this bill draft over the coming months.
All right. Well, let's think a little bit of it. You bring up Paxos, and that's a bit of a sore spot with the industry right now. So we heard from SEC Chair Gary Gensler on Tuesday. So he testified. He had a little bit of he got some pushback from Congress as well, but he repeated his stance, which he said many times. He believes the SEC already has the authority to regulate crypto, and he believes virtually every cryptocurrency is a security. So we saw the SEC come after Paxos for their BUSD. This is Binance's US dollar stablecoin. Many saw it as an attack on Binance by proxy. So how has this approach by the SEC impacted reserves plans? I mean, if you're looking to partner with different companies that have liquidity, that have customers, where the market is, and you want to create a stable coin, does this create worries where even if you're properly collateralized, even if you're backed the way they like, who are you partnered with, where are they based, and how's the SEC feeling about them this week? How does uncertainty on this level of kind of partnerships, how does that impact reserve?
Yeah. Well, the answer might surprise you a little bit because in a way, so the way that the Reserve stablecoin platform works is that it allows anybody to create a new stablecoin, a token that is backed by a basket of existing stablecoins, or other ERC20 tokens for that matter, but let's focus on the simple use case. And what that does is it actually allows for the creation of a diversified stablecoin basket, which kind of solves exactly this issue. Like when we created that, we had in mind that some stablecoin issuers might be shut down, may decide to go out of business, may switch the way that their technology works, and users may not want to use them anymore. And so we didn't want to go attempt to offer stablecoins as money to people in economies that have currency issues and be totally tied to one particular stablecoin issuer because of the sort of issues that we've seen recently with Paxos coming under some heat, or there was a brief scare of what if USDC has a little bit less backing because of the banking crisis. You do have to worry about any particular issuer being around for the next 100 years and always performing as expected. And so the Reserve protocol essentially allows one to depend on a basket of different issuers, and it has an automated functionality to trade out of any particular stablecoin if an issue is detected, and that's all just detected based on price feeds. It also has one other piece, and not to spend too much time on Reserve, but basically there's this excess capital from our governance token stakers, which can be used to make up for a loss. So let's say that there was a basket that contained a stable coin that lost 10% of its value, that would be sold off. And as long as there's enough of these other tokens, the ultimate stablecoin holder would be made whole. So it's actually sort of built to handle this sort of circumstance. And so in a way, yes, stablecoin issuers having troubles is a challenge, but the Reserve protocol in a way was built to handle that. And so it's something where we've seen increased interest in some of the stablecoins on our platform as a result. And so I think that, but stepping back on a broader level, not to just focus on Reserve, I think that the question of do we need the SEC to come in and regulate stablecoins or not? I think it's a really important question where stablecoins in a way have been less the focus of securities laws for the simple reason that most of them are meant to stay worth $1. And most people in the crypto world think of securities just with the Howey test. They're only asking themselves whether something is an investment contract. But something that's meant to stay at $1, obviously you have no expectation of profit. And so it's felt to many like an open and shut case to say, oh, well, this stablecoin isn't a security because there's no expectation of profit. But there are, of course, many other types of securities that are listed in the 1933 Act. It's not only investment contracts. And so there's a question of whether a stablecoin is an evidence of indebtedness or some other instrument that the securities laws refer to. And in principle, if you think about it, like if the securities laws are there to force these asset issuers, securities issuers, to disclose information that they wouldn't ordinarily want to disclose to their users, to the purchasers and holders of their securities, it kind of makes sense that we would want that same sort of regime for stablecoin issuers. You know, we do want the holder of a stablecoin to be able to know what's backing it. And if something goes wrong in the background, we don't want that to be hidden and kept a secret from the users. And so I can see why some folks at the SEC might think, well, maybe we should step in. Even though there's no expectation of profit, there's still this centralized entity that has potentially private information that could, that they may choose to hide from the end user. And so maybe we should force them to disclose, which is what the SEC often is doing for issuers. I think, though, that a lot of the ways that the SEC handles things probably doesn't fit very well with stablecoins, which are more meant to be a monetary instrument in many cases. And so I think that's one reason why it's so exciting and could bring a lot of resolution if we actually do get a law that is directly focused on stablecoins, because then we'll handle that, right? It'll be somebody's job, to make sure that stablecoin issuers are disclosing the relevant information and not engaging in any sort of fraud in the background, et cetera. And I think for those at the SEC who've been wondering, well, do we need to step up? Like, is no one else going to handle this? I think at that point it'd be like, okay, cool, that's handled. We don't need to worry about stablecoins. We can focus on this other area. And so, I hope that we get legislation, because I think that, in a way it makes the SEC's job a little bit easier and probably leads to a regulatory regime that will be purpose-built and more sensible for this very important area.
Well, let's hope you're right. That's a very positive reading of where this is going. But it does look like they might be carving out an area that's less contentious and trying to move that forward, almost as a proof of concept. Here's the part of the crypto sphere that we can regulate, that we can get up and running. That's not going to go crazy, and let's see if we can make that happen. So that's very encouraging. Thank you so much, Nevin. This has been a great drill down into the nature of stablecoins and what we might be seeing going forward. And obviously, this impacts the entire crypto industry.
Yeah, thanks again for having me. Enjoy joining you.
Thank you for watching Kitco News. I'm Ernest Hoffman. Keep it here for more coverage of what's moving markets, and don't forget to subscribe to our channel.